So how does this impact global capital markets? All right, Ukraine is going to have access to these dollars, assuming that a peace agreement can be reached, which allows for, these projects to be developed, and come to fruition, right? So there's that ability on the table to repay their dollar debt, which on the net is good for your Ukrainian debt. That's dollar denominated. These bonds had been what I'd call kind of tip of the spear in the offshore dollar market. Most of the funding is coming from the offshore dollar money centers. So it's non-U.S. capital, but it's dollars, right?
It's dollars. Okay.
So the offshore dollar, the fact that these bonds can be made money good, because for the last 3 years, the trend of this war has not been going well, from that perspective. They're in a financing pickle, and it's been that way for several quarters now. Those dollar debts becoming money good, which are, primarily European, London, they're on their banks, their pensions, their financial systems balance sheet, predominantly. There's some domestic U.S. exposure through like emerging market credit funds, stuff like that, but not much, right? Like maybe 5 cents of every dollar, something like that. You make those bonds money good, which we're trading at massive discounts, right? They're yielding 15%, 16%. They're low coupon because Ukraine couldn't afford much, if any, interest, debt service while this war is going on. So these dollars, which are trading at, fire sale prices, in terms of their dollar price, those things start to look like money good with this deal, which is a favorable for European and British, et cetera, offshore money center banks, which are stuck with this debt, right? So it's actually a good thing for capacity in the dollar perspective in the offshore dollar system, which means there's more ability. Your mark to market on your balance sheet, market to book goes up. You have more capacity now to go out, make new loans, buy dollar debt. And where it shows up at the tip of the spear is on the treasury curve, right? So the way this works out in the whole kind of chain of flows should equate to treasuries coming in, right? Because like you used to think about it, like your most risky bonds on this thing you had to fund, and at some point you didn't know how much it was bad money, right? But you had to keep doing it because you cannot lose this war in Ukraine. Like I don't know if it's quite existential for the Western European democracies, but it very well could be, right? So you have to keep funding this thing. And while the bonds are priced at 50 cents on the dollar, and you have to keep refinancing those, rolling them over, like you literally have to keep throwing in good money after bad is what's going on. This situation is a major pivot because now it's like, wow, thank you, Scott Bessent. Did you just make the bad money good? All right. So now these 50-cent bonds, they start to get priced up closer to par as the market views, this situation hopefully progressing favorably for the Ukrainian bonds. That's healing your own balance sheet, your own exposure as a lender into this initiative. And so you have more dollar capacity to finance other things. And then your cost that you're charging other players, like you're willing to buy, dollar debt or treasuries ultimately, at the final kind of endpoint, the safest dollar debt in the perspective of this global dollar system. you're willing to fund those at lower yields, right? So ultimately, this should, if it continues to work through, play out in treasuries, coming in, which we already kind of know that there's going to be cuts on the front end, to finance overnight funding, relieve stress. But that really only impacts the curve from 2 years and in. What really matters from treasury financing and this key objective that Scott Bessent has mentioned is he's watching the 10-year, right? He needs to get the 10-year cost of debt financing to come in to roll over, like, I think $7 to $9 trillion. I forget what the exact number is that they need to roll over throughout the rest of 2025. So this is a favorable on that process from the U.S.'s perspective, but also if you're one of these European banks or London banks who's got or pension who's got massive exposure to the Ukraine's war debts.